Speaking of Alternatives with Keshav Rajagopalan, Managing Director, Head of Product and Strategy and Multi-Asset Solutions at PGIM.
Welcome to Speaking of Alternatives. Today, we're bringing you highlights from the PGIM EMEA Investor Forum. Recalibrating resilience was the dominant theme of our 6th annual forum in London. In a period of lasting structural change, investors are rethinking how portfolios can deliver resilience, flexibility, and long-term growth. In this episode, we'll focus on some of the sessions of the forum, including structured fixed income and the resurgence of securitization, digital infrastructure powering the AI era, and CIO perspectives on resilience and long-term portfolio design. But first, we'll explore how private credit has evolved from a niche allocation to a core pillar of institutional portfolios. My colleagues Tom McCartan and John McNichols discuss the convergence of public and private fixed income and what it means for portfolio construction. A critical aspect in modern portfolio design has become liquidity. As markets evolve and private assets grow, investors face a delicate balance between capturing illiquidity premiums and maintaining flexibility to meet future obligations. Let's hear Tom's and John's thoughts around this topic.
It's obviously highly relevant, but it varies by investor significantly, right? It's a very different question for an investor who has 10% of their portfolio in private assets and few near liquidity constraints, and one who has 60% and a lot of concern about it, right? You're going to treat that decision for that marginal portion of illiquidity a lot differently. I'd say for the former, you're going to think more about the return. That premium is going to be really attractive, and you're going to be more focused on it, maximizing it, just accessing it any way you can. And in the latter sense, you're going to be very focused on your own liquidity position and how close you are to that edge and what the likelihood is in an empirical sense that you run out of liquidity. And that's not something that your manager can do for you. They can help, but that's very different investor by investor. Now, if you get down to a more micro answer, how do you manage it? I think the tools are evolving. I think that structuring and secondary markets are providing methods to access liquidity, especially now where in private assets generally more acute in private equity, but even in private credit, you're seeing this elongation of portfolios, the capital simply not being returned on the schedule that people thought. And I think that's part of the force driving the increase in secondary markets. But beyond just accessing liquidity, you can also use those markets to manage your risk, whether it's vintage or manager or anything else. From a liquidity standpoint, those tools are going to become more prominent. I think there's more opportunity for that right now than there is capital accessing it, but I think that's going to change. We'll talk about that in a minute. And I think there's interesting things in structuring and borrowing that accounts can do to manage that risk when you get close to the edge.
Risk and return aren't as straightforward as they seem. Behind every indicative yield number lies a host of forecasts, from cash flow projections to currency hedging strategies. Understanding these nuances is essential when blending public and private markets into a single portfolio.
What I would say on that is I think there's a lot of lessons in the public markets that there's not like a neat linear relationship between yield and forward return. Maybe in fixed rate bonds, it's a little bit better, but what we see is a lot of the selling being done on yield. This thing has a really high yield, buy. And I think we learn on the public side is just the caveat around that single number has got a lot more complexity and technical details. Is that a yield to maturity or is that a yield to worst? Is that option adjusted? What are the cash flows assumptions? Is it loss adjusted? How did they treat the fixed or floating? What forward curve did they assume? How did they treat the non-local currency bonds? Did they FX hedge them? Did they rate hedge them back? There's a lot of devil in the detail of when you see what is being touted as a prospective return number there that I think you want to really carefully understand and think about. And the same goes for ratings on the public and private side. There's a lot of differences in the approaches in ratings that we see. The same goes for valuation, which we mentioned already.
I think ratings in private markets need to be taken with a very large grain of salt. First of all, there's a lot of elements of risk management in private markets that just don't fit. I think that's why you really need to think about the firm you're doing business with and what are their policies, what's their history, what's your history with them, because there's a lot of things that are opaque in this market. I do think that this will create larger opportunities for relationships, and so there will be more transparency as a part of that. I mentioned the liquidity piece of a private portfolio, and I think you can use your liquidity in a private portfolio to tap more aggressively to create value. That's one way. I think high yield, the lower you go in the capital stack, the closer these things get to one another. Nobody would say that a deep discounted distressed bond is liquid. Who knows what the heck the rating is? And so I think that's an easy one. If you have a really deep value credit manager, those public and private markets should be coming together really fast. And then on the investment grade side, I think it's really easy and practical to layer in high quality corporates, private placements, infrastructure debt, and then ABF. Those markets are so closely linked. The collateral trades between the markets and the structures are short, so they're a little easier to deal with in a portfolio. Those are some examples of things that we've seen, opportunities to take advantage of these markets getting closer together.
Up next, we'll look at structured fixed income, which is stepping back into the spotlight as investors seek income and resilience. My colleagues Edwin Wilches and Brian Barnhurst explain why innovation in origination and structuring is reshaping how institutional capital is deployed. They'll discuss the critical challenge that Europe faces, driving growth in an economy still heavily reliant on bank financing. Unlocking institutional access to securitized assets is emerging as a critical lever to unlock capital for infrastructure, energy transition, and long-term resilience.
The idea is Europe, and I'm including the UK here, Europe has lagged global GDP, especially when you look at it versus the US or Australia. So the question is, how do we increase GDP? And when you're trying to increase economic activity, you're going to need equity and a lot of debt. Now, when we look at how Europe finances itself, and this is the opportunity in 26, by the way, both in public and private securitized, 85% of the funding comes from banks. So the regulators are in a tough spot. We want to grow GDP, but we can't really grow our banking system. And if you do, you start introducing financial stability risks. Like you're already kind of over-levered to the banking system. So not the silver bullet, but one of the key parts of the Draghi report was we need to expand securitization. Securitization finances the real economy. We're trying to grow the real economy. We need defense spending. We need money for energy transition, and we just need greater output. So securitization has to be part of that solution. We've been working very closely with regulators to talk about not just what we can do to fuel growth, but also what we can do to reduce frictions to allow growth to continue. How do you move forward? You either reduce friction and or add fuel. So that friction is coming from some of the Article 7 reporting. I even extend it to Solvency II. I think we're starting to hear some changes in Solvency II are coming. We expect in the next month or so, there'll be more news coming out around securitization regulation, converging to be a little bit easier to issue. And the premise is we want to have a market where it's transparent. We want to have a market where investors have everything they need to analyze these securities, but you don't want to hold securitization back to your detriment. With the changes of Solvency II, we'll definitely see some more insurance appetite come in. There's definitely going to be much more focus on issuing more securitizations into the market. Again, as the world is trying to figure out how to grow the economy. So a lot of really interesting things there, but all tied to lots of opportunities here in Europe that maybe weren't around the last 10 years because of regulation kind of discouraged everyone from buying it.
All right, let's go from the thrill of regulatory reform to the true big shiny object, private securitized markets. It's got its own branding, asset-based finance, ABF. Yeah. If you were to chart conversations on ABF, the chart spikes probably over the last 3 years. A lot of attention in private assets generally and in private securitized. I think what's really interesting is our focus on origination as a driver of value. Your perspective on the way in which we approach private securitized at PGIM and the deliberateness of our origination capability.
I'd say in the last 18 or 24 months, we've seen this incredible opening of need for private capital everywhere. And now we're even seeing it more so with the AI expansion. I think there's conflating themes happening. When you hear direct private credit, there is a gap between committed amount and invested amount. And generally that gap is because there's not enough to originate. At the same time, when you come over to ABF, we think the target addressable market, the TAM, is probably somewhere around $10 trillion globally. Other folks think this has $40 trillion. And I think the gap there, by the way, is somewhat, do the banks matter or not? In our opinion, the banks are going to continue doing this. They're just not going to do as much of it. And there's going to be a recycling of that capital into private markets. But the number is in the trillions. When we think about this addressable market of 10 or 40 trillion, the question should then be, okay, well, how much has been raised? How much is actually invested in this market? And I think if I'm very aggressive with everyone's pitch books and even our own, I don't think I get to $1 trillion. So what that means to me is that there is a imbalance of capital for ABF.
Securitization plays a key role in financing growth in today's economy. But what role can securitized assets play in institutional portfolios?
Securitized products always been part of multi-sector portfolio construction, particularly on the resi side, going back basically forever. We were probably at the forefront of incorporating AAA CLO, given the risk reward characteristics relative to corporates across portfolios, whether it's multi-sector or even dedicated asset class portfolios like high yield. We've included things like AAA CLO, but that opportunity set is expanding, not only across public securitized, but also the ability to incorporate private, which has liquidity considerations. The second way I think about it is bottoms up relative value intra securitized products, but increasingly securitized products versus corporates. If you look at the headlines over the last few months, a lot of capital going into the AI development trade with a focus on data center. And we see those transactions across the shop, investment grade corporates, US high yield and loan corporates, a little bit in Europe, and then in securitized products. And it's really interesting to look at similar collateral, let's say a data center with different structure around it and different ownership. And we found some pretty interesting relative value, even for the corporate funds in securitized product. And so you're seeing, not unlike the corporate market where public and private are starting to blend together.
Next, we turn to digital infrastructure with Morgan Laughlin and Federico Chiaramonte. The digital economy is hungry for infrastructure, and data centers are at the heart of it. Financing these massive power-intensive facilities has evolved far beyond traditional models, creating new opportunities for private credit and structured solutions.
Data is the fastest growing commodity in the world. There are statistics that say that 90% of the data has been created in the last couple of years, and it's going to continue duplicating its production through the several coming years. Data centers play a critical role in storing and transporting the data to the end users. But also, data centers are mission critical for all low latency applications required nowadays. And in that sense, the magnitudes of these investments are huge compared to just a few years ago. Nowadays, it's not unusual to see 300 plus megawatts campuses. These assets were financed 10 years ago by corporate balance sheets or by some real estate developers. These days, the ecosystem is much more deep and sophisticated. And in that sense, private credit is playing a big role. Private credit matches very well the needs of the data center industry in terms of being able to providing big checks, being able to achieve fast timelines of execution, and providing long-term commitments. We also see the presence of big project finance bank coming to the space, providing project finance style solution, as well as securitization markets such as ABS market in that space.
Artificial intelligence is reshaping industries and attracting unprecedented sums of investments, but rapid growth also brings uncertainty. Behind the headlines, questions remain about demand sustainability, infrastructure capacity, and avoiding pockets of speculative risk.
AI is for real. It's here to stay. It's going to transform our lives. I think none of us fully understand how it's going to impact, but from my perspective, it's absolutely here. There's too much being invested in it. There's too much potential in it. There's too much impact on national security for it not to continue to move forward. Now, as it moves forward, how it's going to evolve, I think, is anybody's guess. And the infrastructure, which is being put in place right now to support the growth, the training, the AI, ML training of that, is beyond the ability of our world to deliver. The demand expectations are beyond the near-term capacity to do that. And there are an awful lot of players chasing the same goal. And so I think it's inevitable that there are going to be winners and losers there. There's going to be consolidation. There's going to be changes in approach. There are already competing forms of AI, whether it's videography or large language models. So there's going to be a lot of change, a lot of uncertainty there. Those data centers are more of a credit play than they are an equity play from our perspective. We very much like what I talked about before, which is a low latency space, which benefits from the historic demand trend around cloud that's still in relatively early innings. You've got the overlay of all traditional colocation. You've got enterprise. You've got the growth of the neo clouds. You've got the inference, which is ultimately going to come from data centers. My conclusion around the AI, I'm a believer in it. I just think there's a lot of risk in that hard assets which are associated with that build out. And our preference is to stick with where we see a much lower risk profile with what we think are similar, if not better, return characteristics.
Finally, we hear from several CIOs on resilience, diversification, and navigating systemic risks in a world shaped by AI and geopolitical uncertainty. Resilience isn't just about hedging against losses. It's about preparing for the unexpected. From managing drawdowns to avoiding prolonged periods of underperformance, investors are redefining what true resilience means in today's markets. Let's hear from Matthew Yates, co-CIO at 7IM, and John Dewey, the CIO of West Yorkshire Pension Fund, on how they tackle resilience in terms of portfolio construction and design. We'll also hear from Christoph Biancat, Chief Investment Officer for Suva, about the importance of staying skeptical when it comes to semi-liquid structures.
We have a range of clients, it's worth saying, so it's going to differ. But I think when people use the word resilient, frequently my mind goes straight to hedging the left tail, or how do you stay defensive? The resilience, I think, has been most painful for many investment portfolios and investment approaches is resilient to the right tail. So not having that asymmetry in how people are thinking about risks, I think, is super important. And then resilient to what in terms of the shape of the drawdown too? So frequently when people are talking about drawdowns, they're talking about some sort of peak to trough fall. I think for most wealth clients and most portfolios, actually, that's not what they need to be resilient to. There's some good research out of Stanford that talks about this idea of submergence as a risk measure. Rather than just how far does your portfolio fall, how long does it stay there when it's fallen? And actually, I think those are the shocks that portfolio needs to be resilient to. Those are the shocks that are less expensive to hedge than some of the short, sharp drawdowns that we've seen in recent years. So it's about thinking about the right tail and the left tail. And I think when we're talking about resilience, drawdowns should be manageable. Submergence is actually the thing that you want to think about putting some protection in against.
I think we have one or a couple of key competitive advantages. One is indeed the long time horizon and the appetite for risk. I think the hard choice we face is that within our investment team, as we've heard today, you can spend a lot of time understanding, debating the geopolitics, the macroeconomics, which is indeed a brave new world. But at the end of the day, there only seems to be one thing driving markets, and that's generating more concentration in global equity markets, in US equity markets. And so much of what we're doing now is driven off the AI capex. So I think the hard choice is how much do you remain exposed to that? How do you shape that exposure? And if, as a lot of people today are predicting, that continues over months, maybe years, how does it unfold and how do you manage concentration, ensure resilience in that environment?
Liquidity comes at a cost, and so does illiquidity. As new structures promise easier access to private markets, questions arise about whether investors are truly being compensated for locking up capital, and what risks emerge when liquidity is funneled into inherently illiquid assets.
So our portfolios are fairly liquidity constrained. We run pretty much daily liquid portfolios for all of our clients. There's a lot of structures coming to market, especially in the UK, being pushed at the moment. The idea of semi-liquid sounds terrifying in and of itself, doesn't it? And I think some of the liquidity structures that are being built to create more liquidity inside of something that is inherently less liquid is dangerous, because I think the vast majority of retail investors in the UK, if there's submergence, they don't have a very good snorkel to sit it out. So the whole idea of democratizing private assets for retail investors just feels to me like something that people need to take a bit of a breath on, because I think the things that are actually generating the excess return premium over the long time, as soon as you create those structures to water those down, that's falling away. So I think there's a lot to be done in the UK to get people more investing, but I don't think creating more semi-liquid structures in private markets is the right way to do it for retail investors.
Christoph, any reactions before we come to the audience?
Just wanted to react to what Matthew said. I wholeheartedly agree that these semi-liquid structures or evergreen funds in private markets are not something that we should cheer for as institutional investors. And I don't like this move and this capital gathering of the asset managers to get access to that pool of capital. I don't think it's to our advantage because, as Matthew said, I think the structures have been as they are for a reason. And I think that's the right setup to actually harvest the liquidity premium.
That wraps up our highlights from the PGIM EMEA Investor Forum. Across these conversations, one theme stands out. Flexibility matters. Whether it's securitization, digital infrastructure, or blending public and private credit in portfolios, institutional investors are rethinking resilience and liquidity for the long term. For more insights from the forum or to listen to the full session, visit pgim.com and type in EMEA Investor Forum in the search bar. Join us next month where we'll be discussing private placements with Mike Campion for another episode of Speaking of Alternatives.
Speaking of Alternatives with Keshav Rajagopalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated, which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2025. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.